You're listening to The Wealth Advocates with finance experts John Mickelson and Patrick Jenkins. The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Well, we want to welcome you all to one of our favorite events, and we're excited to have Robert Spendlove with us, who has been here several times and is one of our most sought-after speakers.
John, it's one of my favorite events of the year because we refer back to Robert Spendlove's notes all year long, and it sets the trend for the conversations. A little background on Robert: he's a senior vice president for Zions Bank, and he reports on their public policy for the bank, and he monitors and reports the economic indicators for public policy and developments for the bank. Robert's interest and research primarily is around macroeconomics. I'm sorry, you got to really work that word. Macroeconomics, demographics, financial markets, and public policy. And I think today we're going to get some nuggets of wisdom on not only what happened last year in 2020, but what that means for 2021 and beyond. So I'm really looking forward to this.
Well, Robert, as we were talking earlier, we were talking about last year at this time, and do you remember the conditions we had last year?
I remember it all too well.
So give us your view of, okay, tell me about a year ago when we did this last year.
So this was actually the last kind of in-person presentation I gave for about 6 months. I was driving up here as the world is shutting down, and I'm like, what is going on? And literally after that presentation, everything shut down. So I'm really hoping that this will be the bookend, and now we start to come out of it and reemerge again.
Well, and it seemed like everything we were talking about, it was like, here's the data, but it doesn't mean a lot because we don't know what's going on.
Yeah, that's exactly right. And that's the hard part with economics, is it's all based on data, and things were changing so quickly that we didn't even know what was happening. And that's been part of the dynamic this year that's been so hard.
Well, and looking back, I mean, you look at the data and you say, what we're doing is looking back to say, does this give us indication of what's to come? And very often, history doesn't repeat itself in the short run. And so that's kind of true right now as well, is we're coming out of it. But, what does that mean?
Yeah, and that's been one of the themes over the last year, is just this uncertainty. We don't know what's going to happen with employment or with GDP or with income. And there's these crazy dynamics that we've seen this year that we've never seen before, and I think you're right, we won't see them again, but that does make it harder to predict what's going to happen in the near future.
Yeah, so I mean, you look at it and think, okay, how do we play this? Because if we don't know a lot of it, like last year, everything went opposite what we thought, and so you have to look at it and say, do I play both sides of the fence? Especially when it comes to my side of things, where I'm helping people with their wealth and their planning. How do we plan for something that is so uncertain? And we kind of have to plan for, is it going to be good or is it going to be rough? And we kind of have to say, it may be both.
Yeah. Well, and I think that's where it's so important to really kind of stick to the plan.
Yeah.
And I'm sure you say this all the time, as long as you have a long-term plan, what happens day to day really doesn't matter. You just kind of have to stick to what you know.
Yeah, very true.
Thanks, John. It's great to be with you today. What I want to talk about a little bit is just kind of what we're seeing in the economy right now, looking at 2020 a little bit, looking forward to 2021, and how unique this year has been. It's been such a different year than anything really we've ever seen before. When we look at the economy over the last year, it really has been a black swan event. If you've ever read or heard of the book, The Black Swan, that came out a few years ago, that's really what we've seen. And what characterizes a black swan event? Number one, they're extremely rare, they're unexpected, they have a severe impact. And then what's really important is they cannot be predicted or prevented. And that's really what we've seen with the coronavirus. There was no way that anyone could have predicted it, and no way we could have prevented it. And those impacts that we've seen have been remarkable in a number of different ways. So first of all, if we look at the change in job growth. So what we're looking at here is the monthly that comes from the monthly jobs report that's released by the Labor Department the first Friday of every month. So we just got this last Friday. And if you look at the kind of the upper left-hand side of that, where you see the impact of the Great Recession, where we're losing, we lost total of 8.7 million jobs, but it was 750,000 jobs a month for about 6 months. And remember how difficult the Great Recession was and how hard it was on people's finances. Then we jump over to the right-hand side of this graph, and you see that we lost 22 million jobs in 2 months. Most of that was in the month of April. In the month of April last year, we lost 20 million jobs in 1 month. That is truly historic and just shows how difficult the economy has had, the difficulty of the economy over the last year. Now, coming out of it, we've seen historic growth as well. And if you look at the next slide, you can see that big drop in April of 20 million jobs. But then in May, we saw an increase of 2.7 million jobs. In June, we saw an increase of nearly 5 million jobs. And we've seen very high levels of job growth kind of returning back to the economy. But even with this, even with the recovery, we're still down about 9.5 million jobs. What that means is that 9.5 million people do not have a job today that had one a year ago. So we're still in a tough period. Kind of zooming in on just that, and part of the struggle with these graphs is the changes that we've seen over the last year have been so dramatic that it just dwarfs anything else that's happening. So what I'm doing on this slide is just zooming in on the last about 6 months. We see that big growth in July and August, then it dropping down into the fall. We actually saw a contraction, job market contraction in December, where we lost about 300,000 jobs. But then in January, started to come back. And the jobs report for February was actually really good. We were expecting about 200 to 300,000 jobs to be added. We added in 380,000 jobs. So that's good. What we're starting to see is a return to growth in the job market. Again, we're still down that 9.5 million, but we are seeing the job market coming back and coming back very strongly. When we look at where the jobs are growing, it's very interesting as well. You see natural resources and mining. So this is from January to February, looking over the entire period, kind of the last year. We see natural resources and mining has been dropping. Construction has been dropping, and I'm sorry, that is actually the monthly change. It's just a labeling difference. We see that one of the big sectors of growth has been leisure and hospitality, which jumped 2.7%. When we look at that in terms of job growth, the actual number of jobs added, that one sector is 355,000 jobs. So big growth in the leisure and hospitality sector, contraction in government, that was specifically state and local government has been contracting. Also a little bit of a slowdown in construction, and again in that natural resources area. But when we look back for the entire kind of time period of the recession, of the pandemic, you see the difference, how dramatic those changes have been. Even with that big growth in the last month, leisure and hospitality is still down over 20% over the last year. At the worst point, leisure and hospitality was almost half of what it was before the recession hit and before the pandemic hit. Natural resources and mining also continues to be down. And the information sector is also experiencing a contraction. And that one thing to point out about the information sector, a lot of people think that is high tech, but what that really is it's movie production, television production, newspapers, magazines, and those really have struggled quite a bit. It's a longer term story than just the pandemic, but the entertainment sector really has struggled over the last year. When we look at the actual numerical change, now this is in thousands. So when we see leisure and hospitality being 3451, that means that sector is still down nearly 3.5 million jobs in that one sector of leisure and hospitality. You also see that every major sector continues to be lower than it was a year ago. And so while we are coming back, there's still a lot of ground to build back in the overall economy. Now, while every major industry is still lower than it was a year ago, there are definitely some sectors that are doing really well in the current economic environment. And you can see that here. Kind of the winners of the coronavirus pandemic. So none of this should come to any surprise. Couriers and messengers up nearly 17%. Building material and garden supply stores up 10%. Computer and electronic products up 8%. I mean, this is right. This is essentially describing the world that we live in. If we get stuff, we get it through Amazon. When we go to the store, what do? We buy stuff to fix up our homes because we never leave our house anymore. Computers and electronics, again, we have to be upgrading our computers because we're Zooming everywhere. Warehouse clubs and super centers, the big shift to kind of the Costco's and the Sam's Clubs. And so you can really see that while most industries are still struggling, there are definite areas that are thriving in the current economic environment. Now, when we look at the most recent economic conditions compared to past recessions, you see how dramatic this is again. And what you see, often we talk about kind of a letter to describe the economic recovery. Is it going to be V-shaped or U-shaped or W-shaped? And you really see that here. So if you look at the 2007 or the impact of the Great Recession, that's really an example of a U-shaped recovery where it kind of drops down, stays low for a while, and then takes a long time to come back up. As compared to something like the 1980 recession, where it was a quick drop, quick recovery, that would be a V-shaped recovery. And then you look at 2020, and you just see how dramatic that is. It's so different than anything we've ever seen before, where it's a sharp drop, and we start to come back quickly. It starts to look like a V-shaped recovery, but then right around the fall, we start to see that slow down. And while the economy is coming back, it hasn't been coming back to the degree that we would have anticipated, and it's kind of turning into, rather than a V or a U, it looks more like a Nike swoosh or a reverse square root sign, where we have the quick drop, an initial quick recovery, but not fully recovering, and then kind of a longer tail. Now, the question right now is, where will we move from here? Will we continue to see that recovery accelerating, or will we see it more of that long tail like we saw coming out of the Great Recession a decade ago? When we look at the total picture, so this is kind of taking those individual lines from the last chart and putting it all in one line. So this is going back to 1939. And you see what normal recessions look like. It's kind of the general up and down, kind of a gradual. When we have a recession, it kind of tapers off, and then we have the trough and then the expansion until you jump over to the last 12 months, where it just dropped very quickly. And even though we're coming back, we're still not back to that pre-recession level yet. And that's what we will be. That's really, this chart is critical to the Federal Reserve, who will be setting interest rates, essentially deciding how the economy looks coming out of the recession. And one of the main goals of Jerome Powell, the chair of the Federal Reserve, is to get this number back to the pre-pandemic level, to return those or reemploy those 9.5 million people that are still out of a job. When we look at the unemployment rate, again, you see how dramatic and historic what we've seen in the last 12 months is compared to history. So this is going back to 1948. And you see that our highest unemployment rates that we've seen, go back to 1982, we were at 10.8%. Looking back in 2010, we were right around 10%. And then, kind of dropped down after that. Last year, in the month of April, the unemployment rate was 14.7%. We in kind of the records that we have kept, when we talk about the normal economic period, we often refer to it as the post-war economic period, because essentially after around 1950 is where we have good data for most of this, and we just haven't seen it. We would have to go back to really the Great Depression to see the kind of unemployment that we saw last year. But so it spikes up at just under 15%, but then look how quickly that's dropped back down. So the economy is recovering quickly, but we're still at 6.2%. So that level where we want to see the unemployment rate be is right around, and you can see that red shaded area, 4.5% to 5%. That's where we consider the economy to be in full employment. And that's really a situation where anyone that wants to find a job can find one, and employers can also find the employees that they need to really operate efficiently. We're still above that in the U.S., and the goal is to get that unemployment rate back down to that 4.5% to 5% level. And so that's what the Fed is really focusing on in there. The Fed has what they call a dual mandate. And Congress actually mandated in the 1970s that Congress has to focus on two things as they work on monetary policy. And that's number one, full employment. So kind of that red line that we're looking at. And then number two, stable inflation, stable and low inflation. And I'll talk about that in just a minute. But that's kind of the struggle that the Fed is running into. Is their main goal, one of their main goals, is to get that unemployment down and get more people back in the labor force. When we look at, and one of the really unique things this year, just like John and I talked about, is the dramatic nature of change that we've seen over the last year. And it was the data was changing so quickly, and the economic conditions were changing so quickly that we had to kind of throw out many of our typical measures of economic health. Most of the data that I use is updated on a monthly or a quarterly or even a yearly basis, but that wasn't quick enough to really understand what was happening. So in this chart, we're looking at the weekly change in unemployment insurance benefits. So essentially what this is looking at is if someone is laid off from their job, they go into the labor department and file a claim for unemployment insurance benefits. And if a week later they continue to be unemployed, then they file a continued claim. So you can see that the green line in this is the weekly initial claims. So people that have just been laid off and have just gone in to get their unemployment insurance benefit. The blue line is after they've continued to be unemployed, and that's the continued claims. You see that jump. So pre-pandemic, we were seeing about 282,000 people losing their jobs every week. That jumped to over 6 million, nearly 7 million claims at the end of March. So, I mean, just about a year ago, we saw that huge spike. Then it drops down, but even today, so this is, a week ago, the most recent number is 745,000, which means that last week, 745,000 people lost their job. So we're still at about 2 to 3 times as high last week as we were a year ago in people losing their jobs. So we're still not quite out of the woods yet with the ongoing claims. Then when we look at the continued claims, jumps all the way up to 25 million. So we had 25 million people that were receiving unemployment insurance benefits in mid-May. And that has dropped down. So now we're just over 4 million. Much better than we were, but it's still at an elevated level compared to pre-pandemic. Just as a comparison, looking at the Utah data, similar trend, but we saw a much quicker recovery. So before the pandemic, about 1,300 people were losing their jobs a week. That topped off at about 33,000. Just a huge jump. But now we're down to about 3,000. But again, we're still about 2 to 3 times as high as we were pre-pandemic, but a much steeper decline in the continued claims. And that really started right around August, going into November, where we saw a much more dramatic drop-off in those continued claims as the Utah economy has recovered very quickly and much better than most other states and the rest of the nation. Looking at labor force participation is another interesting indicator of where the economy is, how it's very unique this time. And essentially what the labor force participation rate is saying, of the total population, how many people are working or looking for a job. So that's what that ratio is really looking at. And you can see that we reached our kind of peak labor force participation in March of 2000 at about 67%. Going into last year, so a year ago, we had labor force participation around 63%. Then you see the big drop down to 60% from the pandemic. But even now, we've recovered, but we're not back to where we were before. The latest data shows 61.4%. So even though we're bringing people back in, that unemployment is dropping, we've still got a huge gap in this labor force participation rate, which means that not only are nationally are people struggling to find jobs, but many of them have entirely given up on the labor force. They've kind of said, I can't find a job, so I'm going to stop looking. And then they leave that unemployed number. So even that 9.5 million doesn't fully reflect the impact of the current struggles. And so that number could be an additional maybe 5 or more million people that have completely given up on the labor force and are kind of sitting on the sidelines. So to really bring the economy back to where it was before the pandemic, we need to not only get that unemployment rate down, but get that labor participation rate back up to where it was pre-pandemic. Another kind of indicator that I watch really closely is this long-term unemployment. This is defined as people who are unemployed for 6 months or more. And that's a critical level because the longer someone is unemployed, the more difficult it is for them to kind of re-enter the labor force, to reconnect, because they lose those connections. They lose those skills. They lose the connections to people and institutions. And it can be more difficult for the entire economy to come back if that long-term unemployment gets too high. You see that in the Great Recession, that long-term unemployment topped out at just under 7 million. Where we are right now, we're at 4.1 million. Now remember, we're only about we're just hitting the 1 year mark of the dramatic impacts of the pandemic. So we're just seeing these numbers coming in. I expect that we will continue to see that long-term unemployment number go up. It could even surpass the Great Recession levels that we saw of around 7 million. But that's an area that we really need to be addressing a lot of our economic policies to try to keep that long-term unemployment as low as possible. Another one of the really unique dynamics in the over the last year has been the impact on wage growth. So if you think about, what have we been talking about? 22 million people lose their jobs. Unemployment rate goes up to 15%. What would you expect to happen to wages? You'd expect wages to crash because so many people are out of a job. We saw the opposite, which is what you see in this graph. We saw the wage growth go from about 3% before the pandemic up to nearly 8% in May of 2020. And again, what this reflects is the nature of who lost their jobs in the pandemic. So what happened was that those workers that lost their jobs were overwhelmingly in blue-collar professions, in leisure and hospitality, and personal services, in travel and tourism. And so when those low-wage workers lost their jobs, it kind of dragged up the overall wage growth number that we see for the economy. So it really is a reflection. So we can see this wage growth chart not as an indication of what's really happening, but an indication of who is being impacted by the recession. So when we see a spike in wage growth, it means that low-wage workers are losing their jobs. When we see it drop, as we saw from May till about November of last year, it's a reflection that those lower-wage workers are coming back into the labor force. But then, if you see that spike from November to December, again, there was a resurgence of the virus, and many of those businesses that had reopened had to shut down again. So we saw that wage growth going back up again. Again, it's just this kind of counterintuitive measure, but it's been really interesting. So one of the goals that we should be striving towards is, surprisingly, lower wage growth, because lower wage growth, below this 5% would be an indication that the labor market is normalizing again and coming back to its long-term norm of around 2 to 3%. When we look at GDP, gross domestic product is the broadest measure of economic health. Again, going back to 1948, we've never seen anything like we saw over the last year, where in the second quarter, GDP dropped by 31.4%. And then in the third quarter, it comes back by 33.4%. I mean, just these enormous fluctuations that we've seen over the last year. Now, if you look at, down 31%, and then up 33%, you probably say, okay, well, that was tough, but we're out of the woods. We're back positive again. But if you look at the absolute value of GDP, you see that even with the big recovery, the big surge in the third quarter, we're still about 3 to 3.5% below the high point in GDP that we saw in the fourth quarter of 2019. It'll still take some time for GDP to come back. Now, with the federal stimulus, I think we will see higher than expected GDP growth, but we probably won't see that until probably the latter half of 2021 until we start to see that growth. But we've still got some ground to build back on GDP as well. One of the reasons that the economy hasn't come back as much as we would expect is consumer confidence remains much lower than it was pre-pandemic. We had a strong surge in consumer confidence from 2016 to mid-2017, where we saw it jump from about the low 90s to above 120, which would indicate that people feel like we're in a prosperous economy. That higher level remained until early last year, until February of last year. But then that consumer confidence took a big hit with the pandemic and the recession, dropped all the way down to the high 80s, and it's kind of remained in that low 90 level ever since. The latest data just came in at 91.3. So consumers don't have the same level of confidence that they had a year ago, and they remain reluctant to engage in the economy compared to what we saw pre-pandemic. You also see this in the personal savings rate. This is another really interesting one, another one that's kind of counterintuitive. It's good for people to save more, but this historic spike in the personal savings rate reflects how nervous people are about the economy, and then you combine that with historic levels of fiscal stimulus. When you think about the direct payments or the PPP loans or enhanced unemployment insurance benefits, all these have just been essentially free money flowing into, and I'm putting free money in air quotes, free money flowing into people's households, into people's businesses. Ben Bernanke, the former chair of the Federal Reserve, said, a way to stimulate the economy is to drop money from a helicopter. And in fact, people called him Helicopter Ben. And that's literally what's been happening over the last years. $6 trillion in helicopter money just being dropped on the American economy. And while people, the hope of the feds in doing this, in terms of the economy, the hope is that people will go out and spend that money. But what we saw was people held on to a lot of that money. They did spend a lot, but we saw that savings rate jump from about 8% pre-pandemic to 33.7% in April of 2020. So people held on to a lot of that money because they're nervous, because their economic prospects weren't what they expected, and also because it was hard to spend money. If you think about, we can't travel overseas. We can't. We're not commuting as much as we used to, and even our supply chain has broken down in a lot of ways, and that continues to this day, where we're still having supply chain difficulties. And so it's not, if you think about, trying to buy a new car or a trailer over the last year, it's been more difficult than it would have been a year or two ago. And so people are just kind of holding on to more of that money. As the economy has been improving, that savings rate dropped down. And in November of last year, it was down to about 13%. But you see, it started to go back up again. A big dynamic of that in January is because we got another round of federal stimulus. And now that we have a third round of federal stimulus coming in, $1.9 trillion of federal stimulus, I expect to see that personal savings rate start to spike again. It could even go higher than what we saw last year in April. On the other side, we see equity markets have seen historic swings where it was literally just around last year when I was giving this presentation, the equity markets were in the free fall. The free fall started at the end of February and continued all the way, till about the end of March. Just that 1 month period of just really tough drops in equity markets. But since then, the stock market has come back really strong, and just in the last few days, we've seen once again historic highs in areas like the Dow Jones Industrial Average. But there is optimism in the markets about future economic prospects. And also, this also reflects actions of the Fed in essentially encouraging people to be saving more money, to be investing more money. And so we see that result in equity markets. Looking at the oil markets, another interesting dynamic where we see that in green, we're looking at oil prices, and in blue, we're looking at oil production as measured by oil rigs. And you see that there's two big dynamics. There's one in 2014 and 2015. That's a supply-driven shock to the system where Saudi Arabia flooded the market with cheap oil and drove prices down from about $100 a barrel to $24 a barrel. And then look at that production. Oil rig count goes from around 1,600 to way down to about 300 active U.S. oil rigs. Recovered after that, but it never got back to that 1,600 level again. Oil prices have been in kind of a tight range of around $40 to $80 a barrel, but that extraction never came back. Then you fast forward to 2020, and there was a period, just a few days, but there was a period in April where we actually saw negative oil prices, where oil was it was actually about negative $40 a barrel. In other words, you had to pay someone to take oil off your hands. Now it's recovered since then, and we're now right around $60 to $70 a barrel. But look at that extraction. It is nowhere near where it was even just a few years ago. Even with a small recovery, we're only around 300 active U.S. oil rigs. So we're still lower than the low point that we saw after that supply-driven collapse back in 2014 and 2015. The Federal Reserve, like I said, has been extremely aggressive in using all their tools to spur economic growth. And one of those ways that they've done that is the federal funds rate. That you can see how quickly they dropped that rate back last year in the spring, all the way down to zero. And I expect the Fed will keep the federal funds rate at a very low level until they start to see really strong economic growth. Now, one of the struggles, like I said, with all this federal stimulus is there is a real fear of inflation starting to go up. So we just got the new data, the consumer price index this morning. So the new number is that for February, CPI was at 1.7%. So we're starting to see that inflation going up, but we're still below the Fed's preferred level of 2%. But one of the things we know is that when we have such an enormous flood of federal money coming into the economy, it does result, and also the accommodative Federal Reserve policies, that does produce inflationary pressure and also produces the possibility of asset bubbles. And so this is something I'm going to be watching really closely. Will we return back to, and if you just look back pre-Great Recession, we had inflation of around 5.5%. There's a very real chance that we could return back to that much larger inflationary level that we haven't seen since for the past decade or more. So if that starts to happen, if we start to see those signs of high inflation, the Fed will have to get more aggressive, and we'll have to start raising interest rates again, raising that federal funds rate. And we're already starting to see early signs of that in the longer term market, specifically that the 10-year bond market is starting to go up more dramatically. Another concern that we have with this federal spending, and it's something we've got to get serious about, is the impact on the national debt. I just pulled these articles from recent newspapers. So the New York Times: mounting federal debt puts U.S. at risk of fiscal crisis, according to the CBO. And the Wall Street Journal: U.S. national debt is likely to nearly double by 2051. You can see that on the right in the chart, where we're now approaching the highest national debt as a share of GDP that we've ever seen. We're back at World War II levels right now, and that national debt is expected to double over the next 30 years. And so this is a real concern that we've got to get serious about if we don't want the economy to have long-term struggles as we move forward. So quickly, just closing out, looking at our more local conditions, and this is as tough as the national scene has been, the Utah economy continues to be very strong. Utah over the last year was the third fastest growing state in the U.S. You can say that Utah tied for number 2, with Idaho on top at 2.1%, Utah and Nevada right behind them at 1.5%. And the majority of that growth is because of what we call net migration. So people moving into the state. The Utah story is really getting out there, and we're seeing a lot of demand for people who want to come into the state and benefit from the Utah story. When we look at where it's growing by counties, you see the big growth happening in Utah County, Tooele County, kind of these areas on the we call this a donut effect, areas that are on the periphery of the urban core. So you have access to urban amenities, but you still have the benefits of a more suburban or even rural setting. And then also big growth in Washington and Iron counties. That's a long-term trend as well. When we look at job growth, Utah is one of only 2 states that has positive job growth. So every state saw job losses over the last year, but Utah and Idaho are coming back really strong and are the strongest economies in the nation. When we look at where the employment is growing by county, again, you see, look at Utah County growing 2.5%. That's remarkable growth for a county the size of Utah County. And then also Washington County growing 3.6%. Again, very strong. And then kind of up locally, Cache County growing 1.2%. Salt Lake County continues to be negative, contracting about 1.7%. But the big losses, look at Summit County, 12.5% down. The Uinta Basin down about 6%. And then the southeastern region of the state down, between 3 and almost 10%. And that again is that dynamic that we're seeing. It's kind of the double impact. In Summit County, it's that travel and tourism. In the Uinta Basin, it's the energy sector struggling. And then also in the southeastern part is travel and tourism drops. When we look at the unemployment rate, again, we also saw a big spike going from 2.3%, which I'll tell you was too low, all the way up to over 10%, the highest unemployment rate that our state has seen since the Great Depression. But now we're already back down to 3.1%. So really dramatic and strong recovery in the Utah labor market. And the unemployment rate in Utah is also one of the lowest in the country, along with Idaho and parts of the Midwest. That when we look at the unemployment rates by county, you see that there really is kind of an urban-rural divide going on in the state, where we have very low unemployment in areas like Salt Lake County, Utah County at under 4%. Cache County and Rich have always had historically very low unemployment rates, and they're back there again. Cache at 2.5%, Rich at 2.7%. Washington County also very low at about 3.9%, but much higher unemployment again in Summit, in the Uinta Basin, and in San Juan County, where there's still just under 8% unemployment. And then that labor force participation, that's a really interesting one. Again, you see in green, the U.S. labor force participation not back to where it was before, but look at Utah. We have fully recovered. Our labor force participation is back to where it was pre-pandemic. So it shows the strength of the Utah economy relative to the national economy, where we have fully recovered from the recession. Now, one of the byproducts is we're also seeing, and this is one of my concerns though about the local economy, is we are seeing big inflationary pressures, and you see that with home prices, where when we talk about the housing bubble of the Great Recession, that's what we're looking at in this graph. When you look at March of 2008, the home values in Utah were at $260,000. Everyone was lamenting how high that is. Where are they now? The median home price in Utah just passed $400,000, much higher than they were in the before the Great Recession, and also much higher than the nation, which also just hit an all-time high at $270,000. When we look at housing price appreciation, you can also see that not only are the prices going up, but they're accelerating in their appreciation, where Utah is now at 13.3% year-over housing growth compared to the nation at 9.1%. So kind of looking ahead, what do we expect? Again, what we've seen over the last year is something we've never seen before. That black swan event was very remarkable. It was dramatic. It was swift. It was unpredictable. And it was unprecedented. And like I said, we will not see anything like this probably again in our lifetimes. The economy currently is coming back, but it's still constrained. There's still a lot of parts of the country and parts of the economy that remain either shut down or in a less than full capacity. But as the economy recovers over the next 6 months, and we will see economic growth accelerating, when you add into that continued federal and state stimulus, it will cause the economy, I believe, to surge, and we will see much higher inflation. The question is, how high that inflation will be and how aggressive the Fed needs to get. Again, their goal is to bring back those 9.5 million jobs. But how do you do that without dramatically surpassing those inflation targets that they are always working toward? And it's going to be a tough one for the Fed to try to balance that. But going into the recession, I would say that both the U.S. and the Utah and the Western regional economies were fundamentally sound. Remember, this recession was caused by the black swan, not by weakness or inefficiency or mistakes. And I believe that as we recover, those fundamental, the economic fundamentals will return. And I think we will return to a period of strength again in our economy. So thanks so much.
Once again, Robert Spendlove, thank you so much for joining us. This is probably our 4th time we've had you here.
Yeah,
it's always
great.
such a pleasure. And you covered great topics. A black swan event is a real catalyst for everything that occurred last year and has a projection into years coming forward. You talked about population migrations. That's a big deal to us. Inflation, even market turnover and market turmoil that's occurred. Can I ask you just a couple questions just to follow on?
Yeah.
Calendar-wise speaking, we expect in 2021, 2022, and going forward, nearly 10,000 people retiring every single day.
Yep.
Not month, every day, 10,000 people. And that black swan event of COVID and the setback that has occurred has a little ripple effect inside the demographic economy. People retiring, people coming online. The millennials aren't coming on nearly as fast. The retirees are not retiring. They're hanging on to their positions. Just an opinion, what do you think is happening in the economy, Utah economy, nation economy?
Yeah, there are some really interesting demographic components of this. And again, it's one of those areas that we're still trying to figure out exactly what's going on. Female labor force participation is way down. So we're seeing, and not only the baby boomers, so it's kind of a combination. Some of them have had to hold off because of market turmoil, but then others have been kind of pushed out because of the changing nature of the labor force. So if you used to be a barber, it's really tough to do those personal services. So we're seeing one of the themes that I've seen, and I think will continue, is the economy is going to come back, but it's going to come back different than what we saw before. We saw that in after the Great Recession. The economy fundamentally changed after the Great Recession. We are right now in the middle of another fundamental change in our economy. We don't know exactly how it's going to come back. Will we all be back in person a year from now? I don't think we will.
Really?
Will we be traveling as much as we were? I don't think we will. I think we'll be doing in person, going to work, but I think it'll be a different type of work where it's a combination of Zoom and in person. We'll be traveling, but I don't think we're going to be flying to New York for a 1-hour meeting. I think you'll Zoom into that. So things are going to change, and those demographic impacts are going to be really interesting to watch.
On that same theme of demographic impacts, you've talked about that migration that may be occurring in Utah. You talk about Washington County, you talk about Iron County, Tooele, the periphery of Salt Lake and Provo area, Utah County area. What impact is that going to have on housing? It feels like housing's in a tremendous bubble. People talking about that bubble popping every day. What's your opinion on all that?
Yeah. So, and that's as those, part of that dynamic. There's two parts of the dynamic of housing price appreciation. There's both nationwide and in the Intermountain West, and specifically Utah and Idaho. Mm-hmm. The one dynamic is very low interest rates. So the Fed dropped rates down. The 10-year bond dropped. The 30-year mortgage is tied to the 10-year bond, which is it's just the way it is. And so the 10-year bond dropped way down, and so we saw kind of historic lows in the cost of a 30-year mortgage, and so that created that demand nationwide. But then you add to that in the Intermountain West, people kind of fleeing the coast and fleeing. We've seen a lot of people moving in from the East Coast, from the West Coast, into the Intermountain West, specifically areas like Boise and Salt Lake and Park City and St. George, where the demand is much higher than our ability to supply. Mm-hmm. And so while interest rates I expect will be going up and 30-year mortgage rates will be going up, that will bring down that type of demand for housing. So we'll see that housing price appreciation drop off. But I think we will continue to see the high demand for housing in the state because that demographic dynamic will continue. So, we're struggling just to keep up with housing right now. So I think you may see that appreciation drop, but I think that absolute value will probably be able to hold steady even into the future because of such high demand for this area for the Intermountain West.
Man, a lot of changes. It's very difficult to project a trend line on any of this. I can't thank you enough for your wisdom and sharing it with us one more time this year. Every year, this is our most popular attended event when we used to attend events, and also our most popular podcast. So Robert, thank you so much for joining Wealth Advocates and being a part of this conversation today.
Well, it's a thrill to be with you. Thanks so much.
Thank you for listening to the Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts. You can also look for The Wealth Advocates on Stitcher and YouTube. Want more information about today's topics? Reach out to John or Patrick directly by calling or texting the Wealth Advocates office at 435-754-7888. Learn more about the Wealth Advocates and how they can help you by visiting www.wealth-advocates.com. Securities offered through registered representatives of Cambridge Investment Research Incorporated, a broker-dealer member FINRA SIPC. Advisory services offered through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Wealth Advocates and Cambridge Investment Research Incorporated are not affiliated.